and welcome to Media Talk. I'm your host, Katie Arcieri, and today we explore where e-commerce sales are headed after 2+ years of accelerated growth during the pandemic. Let's go back to the start of the pandemic in 2020, when online retail sales spiked to more than 16% of total U.S. retail sales during the second quarter. It was during the height of the pandemic-driven lockdowns that forced millions of Americans home. Consumers quickly moved online and looked to major retailers like Amazon, Walmart, and Target to purchase food and other essentials. They also bought lots of discretionary items for their homes. With the help of stimulus checks and rising wages, they bought Peloton bikes, furniture, and big screen TVs. Well, let's fast forward to 2021, when consumers began trickling back into stores and restaurants as COVID-19 cases waned in many parts of the U.S. That shift caused a dramatic slowdown in e-commerce activity and, in turn, slower growth for companies like Amazon, which were also facing headwinds with supply chain constraints. Thus far, 2022 has been a continuation of the e-commerce slowdown, with online sales normalizing to about 14.5% of total retail sales in the U.S. this year. Inflationary pressures, along with higher labor and freight transportation costs, have dragged down margins for the largest retailers. Still, e-commerce sales are expected to remain significant. Online sales could reach something like $1.6 trillion in 2026. That's up from approximately $1 trillion in 2022. There's no doubt that people are shopping online more than before the pandemic. Many are now working from home, and early retirements have increased the presence at home and thus online buying activity. Early adopters of online grocery shopping have developed more of a habit around it. But shoppers are increasingly concerned about inflation in the economy. Consumers are spending more online, but they're finding they are buying less. And rising interest rates are also a restraint on buying activity, whether it's for durable goods or services. So where do we go from here? In this week's Media Talk, we speak with two experts who will give us insights on the future of e-commerce, how retailers are positioning themselves for growth, and consumer sentiment as we dive into the holiday season. Arun Sundaram is an equity analyst with CFRA. Michael Nassarino is an analyst with 451 Research, a unit of S&P Global Market Intelligence. Welcome to Media Talk.
Hey, Katie. Yeah, thanks for having me.
Thanks for having me as well.
Arun, let's start with you. We know that online sales have slowed for Amazon, Walmart, and Target. And all three of these companies had a really tough first half of the year. Many of them sort of realized, we've overinvested in online operations and staff. That's when consumers really kind of pulled back on spending as gas prices spiked earlier this year. Can you tell us some of the measures that these companies took to streamline operations and improve margins right away?
Yeah, great question. So yeah, I mean, obviously the demand environment is normalizing really after we saw the exponential growth, as you appropriately said, over the past 2 years. So yeah, the demand environment is normalizing, and it kind of normalized really fast. We saw it really happen earlier this year, kind of when gas prices started to spike ever since the Russia invasion of Ukraine. And during that time period, we saw a pretty drastic shift in spending. Consumers pulled back on discretionary expenses, and they spent more money on staples and consumables. During that time, that was a pretty rapid and sudden shift in spending patterns. And that took all these retailers by surprise, Walmart, Target, Amazon, and they've had to adjust their strategies ever since. Now, all of them, just about every single one of them are facing excess inventory issues, especially among their discretionary products. And they're having to try to unload that through heavy discounts and promotions. They're just trying to get these items off the shelves and make room for the items that are selling. So that's one thing that a lot of companies are doing. Another big aspect of this is that because the demand environment is normalizing, companies are pulling back on capital investments. I think that's probably one of the biggest things that are the biggest themes that I've been seeing in retail is a big pullback in capital investments. And that's really coming off of really strong investments over the past 2 years. If you look at how much money companies like Amazon, Walmart, and Target spent in areas like fulfillment and transportation, they put a boatload of money into those areas. And now it's about pulling back on those investments and even cutting some of these fixed costs because there's a lot of fixed overhead associated with some of these investments. And the goal of that really is so that even though demand is normalizing, it shouldn't hurt the bottom line because you're also adjusting your cost structure. So that's what all these companies are really doing right now to kind of protect their bottom line in this highly uncertain demand environment.
And let's also talk about Amazon. They had doubled their logistics operation, and now they're really kind of scaling back on that significantly and slimming down. They've slimmed down their workforce as well.
Yeah, that's right. If you look at their fulfillment and transportation capital investments, it grew exponentially over the past 2 years. But this year in 2022, they're actually spending $10 billion less in fulfillment and transportation capital investments. So they're really pulling back on that. And that should bode well for the bottom line. Probably not this year, but we should start to see that flow into their bottom line next year, because these retailers, they run heavy on fixed costs. And they need these assets to run at max capacity or optimal capacity. And so when you're pulling back on some of these investments, you're using your assets more efficiently. So, again, the goal is to really improve the bottom line. That's going to be the theme for 2023.
Gotcha. Now we're rolling into the holiday season. A lot of these companies are in a position to gain some growth during the holidays, even if it's at a slower pace. Michael, I want to bring you in. 451 has just come out with its holiday spending preview. What are some early insights that you can tell us and our listeners about how much people are planning to spend during the holiday season this year?
So we track it more along the lines of consumer sentiment, kind of how they're feeling about their current situations. And we're seeing holiday spending kind of returning to a lower level than we saw last year. Last year, there was a big spike in pent-up demand and the so-called revenge spending, where people were just tired and wanted to get out after being locked up because of the pandemic. And we're seeing some of that fall back down to kind of the levels we saw pre-pandemic. Now, it's not as low as we saw in 2020 when things were really suppressed, but it's kind of somewhere in between the peak of last year with pent-up demand and kind of the low point we hit during the pandemic.
Gotcha. Are people spending less money than a year ago?
So that's one of the things that has been most tricky about the current environment as far as consumers go. Are they spending more because they want to spend more and they have the resources to spend more? Or are they spending more because prices are going up? And by all account, it's likely somewhere in between. There are some segments of the consumer population that are able to continue to spend, really centered more around some of our higher income respondents. And there are others who have had to cut back on discretionary spending and focus more on only buying essentials. But even those essentials are costing them more than they did last year. So there's a mix within the consumer economy as to what is driving the spending sentiment right now.
What seems to be the biggest drag on spending right now?
The biggest drag on spending right now is the cost of goods. Inflation is having a suppressing effect on consumer sentiment as well as consumer activity. While, as we had just discussed, looking at the spending numbers just as a raw predictor, it looks like consumers are spending more or plan to spend more. But inflation is causing them to spend more on less. And they're not as getting much value for their money. And inflation is causing the price rises on energy, groceries, even is playing into prices for housing, and rents go up. For some people, their interest rates are going up. And it just makes consumers feel like they have less spending power.
Gotcha. And Arun, tell us a little bit about how companies are tackling inflation, especially during this holiday season, this critical time period.
Yeah, I mean, obviously prices on the shelves are higher just about everywhere you look, and every retailer is raising prices. I would say most retailers are not raising prices to offset the amount of cost inflation that they're experiencing, meaning they're absorbing some of their costs, but nonetheless, they are raising prices, and consumers are noticing that on the shelves. And that's obviously playing a role in consumer spending this holiday season. But they are looking for ways to spur demand. One strategy this season we'll see is a lot more promotional activity and discounts. Mm-hmm. If you look at retailers' inventory levels, they're in a much stronger inventory position this year than they were last year. Mm-hmm. Last year, every retailer was scrambling just to get products onto their shelves because of all the supply chain issues, the bottlenecks we saw from getting goods from overseas to the US. We're not really facing that kind of headwind this year. So from an inventory perspective, they're it's a much stronger position. And I stated earlier that many retailers are facing excess inventory. So that also helps increase promotional activity and discounts. That's going to be probably the biggest driver there. For e-commerce companies, I think another tailwind for them is faster and more reliable delivery times. Companies like Amazon, now that they're facing less supply chain issues, they're allowed to really improve on getting their fast and reliable delivery, same day delivery to new markets, those kind of things. I think that will also help spur demand this holiday season. But yeah, nonetheless, the big headwind is going to be inflation and the impact on consumer spending. Right. I think that's why a lot of retailers are generally a little bit cautious right now as they approach this holiday season.
And Amazon just recently said in their third quarter earnings report that they did expect that holiday sales would be negatively impacted in the fourth quarter. And so I wondered if you could talk a little bit about that. They had some lackluster third quarter earnings. And their net income did decrease. Tell us a little bit about what Amazon is expecting this holiday season, really the number one e-commerce player in the US. So.
Yeah, they did come out with a kind of a cautionary tone for this holiday season. One disclaimer I would say is that much of their e-commerce weakness will probably lie in Europe this holiday season. You know, in Amazon's perspective, Europe is already in a recession. The consumer there is much more pinched than the consumer is here in the United States. So Europe will be a big headwind for Amazon as well as any retailer that competes there. But in the US specifically, Amazon is also preparing for a more moderate or cautious holiday season. And again, it's the impact of high inflation and weak consumer sentiment. That's what they specifically called out. But, I think the one thing that I can say about that is that there is a bifurcation between higher income consumers and lower income consumers. Generally speaking, most of Amazon's customers are, I would consider, middle income or upper income, meaning that they should be less impacted by high inflation. But nonetheless, they are preparing investors, or they're telling investors to prepare for generally a more cautious holiday season.
Gotcha. And Michael, you and I have talked about how inflation is impacting both higher income people as well as lower income. Can you talk a little bit about how lower income folks are more strained than the higher income folks?
Sure. Basically, it comes down to resources. Higher income households have the ability to absorb economic shocks more than lower income households. As we've seen, even going back to the pandemic, higher income households are able to just stop spending. They had the money to spend what they needed and they cut out extraneous. Unfortunately for the lower income group, even when they cut the most extraneous stuff that they had in their budgets, they were still paying more and to this day still are paying more for non-discretionary stuff, especially groceries, energy prices, and housing prices. Those are the three things that take the biggest chunk out of the lower income budgets, and they're the hardest things to cut back on for obvious reasons. We also see that higher income households have the ability to lean on other financial options. They have money in savings. They can use credit cards. They can get loans. They can take money out of your retirement accounts if they need to. It's a whole plethora of things that make them more able to weather the storm than lower income households that can feel the pinch a lot quicker. And even as things get better, it will take longer for the lower income households to kind of find their balance again.
Great. And I want to talk about how that dynamic is really going to affect online spending. I do see that the survey asks a question about where you and your family will be doing the majority of holiday shopping this year. What can you tell us about what the 451 survey is saying about that?
We're seeing some very interesting things in these numbers. While we are seeing online channels as the most preferred way in which consumers want to purchase items during the holidays, which is being driven a lot by the younger demographics of Gen Z and millennials, we're also seeing an interesting amount of people who want to return to in-store shopping.
Right.
And what's most intriguing about the return to in-store is while we see baby boomers being the demographic who's most interested in returning to in-store shopping, we're actually seeing a pretty consistent level across all the other age groups also. So more generally speaking, we're seeing an interest in return to shopping in store that is pretty consistent across age demographics, which is not something that really would have been expected.
Yeah, it seems like there was a real interest in getting back into stores, getting back into restaurants as COVID restrictions were lifting and as COVID cases had kind of gone down. And I guess, Arvind, let me ask you about, with consumers really returning in force back to stores, is the name of the game increasingly hybrid? Will retailers really have to balance both online and in-store offerings to lure shoppers long term?
Yeah. I think the future will be a mix of in-store shopping and online shopping. It's obviously over the past 2 years, we saw the surge in e-commerce demand. Prior to that, e-commerce was growing, but really the acceleration happened in 2020 and 2021. Mm-hmm. And then now, as you say, this year, we're going back to in-store shopping. But we haven't lost some of that e-commerce demand. I think some of that pull forward in e-commerce demand, some of that should be structural, meaning the e-commerce players should be much stronger today than if the pandemic never happened. And that's just because a lot of people have adopted e-commerce, especially in areas that historically weren't that popular when it comes to online shopping. Think grocery for that matter. That's probably one area we saw a significant acceleration in adoption. Going forward, I think the retailers are going to have to invest in both in-store and online. So it's really a balancing act to control those investments.
And you and I have talked about how Amazon, it doesn't have the brick and mortar network that, say, Walmart and Target have. What advantages does Amazon have with respect to winning online sales? And what about Walmart and Target? Both of them have these extensive network of stores that really can serve as distribution centers.
Yeah, so obviously Amazon, the largest e-commerce company by far. No one really comes close to Amazon. They have a huge subscription base, huge subscriber base, predominantly middle income, upper income consumers. So those are all major advantages. They offer the fastest delivery. No other retailer comes close to Amazon in terms of delivery speed. You can even get items to your door in less than 2 hours now, which is kind of unheard of if you thought about that a few years ago. So that's their major advantage there. For Walmart's biggest advantage is their brick and mortar footprint. Approximately 90% of the US population lives within 10 miles of a Walmart store. So their close proximity to the consumer is their biggest competitive advantage, meaning that they can get products to the customer's door relatively quick, and the cost should be minimal because the last mile delivery is much shorter than some of the other retailers. For Target, I think their biggest competitive advantage is actually their business model. They don't have necessarily the same number of stores as Walmart does, but what Target does a little bit differently is that they position their stores as a fulfillment center. Really, the back of their stores is a fulfillment center for their online sales. So in fact, over 95% of Target's sales are fulfilled by a Target store, meaning only 5% of Target sales are fulfilled by a separate distribution center. So they really use their brick and mortar footprint to their advantage. While many companies thought having a brick and mortar footprint would be a disadvantage, Target actually said, hey, let's use this to our advantage and really try to grow our online business by using these stores as a hub. And that so far has turned out to be a really successful strategy for Target.
Right. And Target is much more focused on discretionary items, whereas Walmart is really more focused on groceries. How has that been a hindrance for them with this upcoming holiday season with just some softness in discretionary spending?
Some years it's a headwind, some years is a tailwind. During the pandemic, when we saw a big shift to discretionary goods, it turned out to be a huge tailwind for Target because they have more of their sales are discretionary. Their margins are a lot better. Target's operating margins can run somewhere between 8 to 10%. Whereas Walmart can't even come close to that because they mainly sell grocery items. In a really good year, Walmart's operating margins are probably around 4%. That's for Target, it's nearly double. So it could be a headwind some years. It could be a tailwind in other years. Obviously, this year, Target's mix of discretionary products is turned to be a headwind because consumers are purchasing less items there. And that's one of the reasons why we're more positive on Walmart this holiday season than Target. It's mainly because Walmart is a grocery retailer first and foremost, and a discretionary retailer. That's their secondary offering.
Gotcha. And Michael, what does 451's survey tell us about what people will be spending more on and possibly cutting back on?
So looking at our data, we referred to it before. We looked at people spending more or less for the holidays this year. And we asked each of those groups what types of things they would be spending more or less on. And kind of echoing what's going on right now, groceries actually come up as the top thing that people plan to spend more on during the holiday season, which is interesting because it's not a discretionary, it's not a gift. Now, I also want to add in the caveat that we asked the question focusing on online, what would they be spending more online compared to last year? But I think it's probably a good indicator kind of overall, especially with something like groceries, that people are just going to be spending more on that this time of year. And it's kind of superseding some of the thoughts about the more traditional things we would have think consumers would spend on during the holidays.
And what do they seem to be cutting back on? I mean, is there anything that doesn't seem to be on the forefront of their minds this holiday season to purchase online?
Apparel is one of the things that's really come up, even in the last couple of quarters overall. People seem to be cutting back on apparel purchases. Consumer electronics are always up and down. Unless there's something driving consumer electronic purchases, like a release of a new device. It's a little bit of a mixed bag this year as far as holidays go. And travel is something that people have kind of pulled back on a little bit too, comparatively also.
Yeah, I see the survey is saying that nearly 70% of people are looking to cut back on travel. And why do you think that is during this holiday season there? Is it the combination of inflation and gas prices that might be leading people to kind of rethink those big trips?
I think it's all of it. I think it's just the higher cost of stuff, the higher cost of travel in general. Even though I know some people have been finding great airline fares and stuff, depending on how far in advance you can book your trips and stuff like that. But I think overall for the average person, I think just travel between whatever your method of transportation is, lodging, by the time you end up setting up the trip itself, you don't really have enough money left to actually have any fun on the trip, is kind of what the sentiment seems to be. For those who do plan to go on trips, we do see some cost-cutting measures that folks are trying to use, one of which is using a more affordable method of travel, which might be driving or taking the train instead of flying, staying with friends or family instead of staying in a hotel, using travel perks from their credit cards. There are things that folks are trying to do to offset expenses if they do choose to go. But just the overall cost of things right now is really kind of biting into people's desire to travel.
Gotcha. And Arun, I mean, can you talk a little bit about if groceries are going to be a big area of spend this holiday season, how will that benefit companies like Walmart? I know Walmart has gained a lot of online grocery market share during the pandemic as health concerns really drove many shoppers online. Has there been sort of a permanent acceleration in online grocery? Is that what we're kind of seeing here?
Yeah, there has definitely been a shift in online grocery spending. If you look at the statistics, I would say around 8% of all U.S. food retail sales come from online nowadays. Prior to the pandemic, that was around 3%. So the penetration rate has nearly doubled in 2 years. And that's all because of the pandemic and the huge pull forward there. If it wasn't for the pandemic, the online grocery penetration would probably be around right now, probably around 4 to 5%. So we probably seen about 4 percentage points of e-commerce penetration pulled forward because of the, and that's obviously benefited these major retailers, the big box retailers. Walmart has been a major beneficiary of that. Also because it's a leader in low prices, and with high inflation these days, consumers are more value minded and value oriented, and they're gravitating towards the low price retailers like Walmart, and it's allowed them to gain even more market share. And again, the Walmart is, like I said earlier, is predominantly a food retailer. 56% of Walmart's U.S. sales are in the grocery category. So they are a food retailer first and foremost, and then a discretionary retailer on the second hand. Whereas like a retailer like Target, only about 20 to 25% of Target's sales are in that food and beverage category. So Target's less exposed to grocery and a much more of a discretionary retailer. So I mean, Target has seen market share gains in grocery. Don't get me wrong there, but it's just a much smaller portion of their business compared to Walmart.
Right, they're not really trying to be a full scale grocer. What about Amazon? Where did they kind of fall in the online grocery business, and where do you see that going in 2023? Yeah. So that's a good question. So Amazon entered the grocery business in general when they purchased Whole Foods several years ago. And that obviously with Whole Foods, that brought them this huge brick and mortar footprint. And everyone thought, oh, okay, they bought Whole Foods. These Whole Foods stores are located
probably close to their prime customer base, meaning they can use these Whole Food stores as a fulfillment center almost to deliver groceries to their end customers.
Yeah.
But that really didn't take off since they bought Whole Foods. But I think now we're really starting to see more investment in their grocery business. They're opening new banners now. Amazon Fresh is one. It's their own Amazon stores. They're opening up more automated fulfillment centers specifically for their grocery business. Predominantly, Amazon invested a lot in automation predominantly for their e-commerce, their normal business, their core business. But now you're starting to see more of that automation investments put into their grocery fulfillment centers. So I think over the next few years, next several years, we should start to really see Amazon kick up in the next gear for the grocery business and really start to gain more market share.
Okay. Really interesting. And looking into 2023, we see interest rates have risen. We know inflation is ongoing. Will companies continue to raise prices, or will they sort of hold the line on that in 23? What is your prediction there?
Unfortunately, I think we'll still see higher prices in 2023. And that's mainly because I cover a lot of suppliers for these retailers, a lot of food manufacturers, a lot of more companies downstream in the supply chain. And a lot of them are still facing cost pressures in raw materials, commodities, transportation, labor, you name it. Mm-hmm. So a lot of these companies are still trying to implement more price increases. Okay. And so that's once that's passed on to the retailer, it's inevitably going to be passed on to the consumer. I don't think we'll see the same rate of inflation as we saw this past year, but I don't think we'll see deflation anytime soon. So overall, I think prices will rise, but not to the same rate that we saw this year.
Okay. Michael, anything to add on that piece of things with the inflation? How will companies respond to the higher prices in the coming weeks and years?
I think we'll see a lot more of what we've seen this last year. We will see consumers having to make decisions about their non-discretionary versus their discretionary purchases, with discretionary purchases ending up being the ones that get cut. The interesting thing will be to see how any amount of continued inflation affects the prices of non-discretionary items and the strategies that households end up taking to make their household budgets work in the face of continuing upward prices.
This has been a great conversation about e-commerce and where it's headed in 2023. Thanks to both of you for joining me today.
Thanks, Katie. Thanks for having me.
Thanks for having us.